The forward-looking markets, technology and crypto, priced in a recession last year. And they've been recovering since because they've been following the forward-looking indicators of financial conditions and other things. Right now, stuff like the Russell 2000 and oil is living in the present day, which is slow economy. Why are these tech stocks going up and everything else is going down? It's because they're forward-looking, as it is their job. So I've been very bullish. I saw the liquidity cycle, which is the key driver of all assets. The liquidity cycle is based around this interest rate cycle, which is based around this whole debt refi cycle. Liquidity started bottoming last year in October, November, December, and that gave us the signal to start getting long both crypto and technology. And that's been, phenomenally good. I mean, this year, the Nasdaq's up 45% and crypto is anywhere between 80 and 500% this year. And that's got people scratching their heads. But our forward-looking indicators of the business cycle suggest we're going into what is, right now we're in macro spring. We're about to start moving towards macro summer. What is macro summer? Macro summer is when interest rates are falling, inflation is falling, and growth is picking up. And we should be in macro summer for all of 2024 and into 2025. And so my forward-looking basis is that the economy picks up, inflation keeps falling, which is the opposite of everybody else's narrative of sticky inflation. And I think the markets are already showing you how excited they are about this idea. So we've still got the problem remaining of that GDP formula because it keeps going up. The higher interest rates go, the more bonds they have to issue, which is why I think they want to bring interest rates much lower than people expect by being so late in hiking. But we've still got the problems with the economy is it's not growing fast enough to pay the interest on the debt. So if the economy on average is growing at 1.75%, and let's say interest payments on debt is about 2%, and the government's 100% of GDP in debt, that's all of GDP just to pay the debt. So what you need is to grow GDP. And to grow GDP, you either need the population to grow. Well, that's not going to happen. Or you need productivity to grow. That's technology. So productivity growth is what I'm really looking at. And it's not this cycle story, but by 2030, we will see AI solve both problems. AI and the robots are new demographics. They're new productive units in the workforce of infinite scale. So we can now have an infinite population of productive people in inverted commas, and that will start driving productivity. The next part of the equation is we need to bring the cost of energy per unit of output down. And it won't come out of fossil fuel markets. It'll come out of renewable energy. So my big picture is we're about to go through an economic revolution, but we're not finished with the downside of slow economies. And that's going to mean more and more use of the balance sheets, ongoing increase in asset prices, and this ongoing cyclicality of the economy. 2008, every major government in the world of a developed economy hit 100% of GDP in debt. So, okay, and interest rates, let's say 5-year interest rates where they generally finance themselves, have averaged around 2% or less. But so is economic growth. So if you think of GDP as all of the money circulating around to pay for the debt, there's no more money left over. But the problem is the private sector is over 100% of GDP in debt in every major country. So who pays for that debt? So that's when they started shoving the interest payment debt onto the balance sheets, because the world basically hit the tipping point in 2008. Once I started putting together this kind of super thesis of the everything code and the exponential age, I started to look at all assets versus each other to say, if you're going to take risk, where do you take it? And everything was inferior to crypto. And I'm like, it becomes very difficult. If you look at it, the best performing asset for 3 years out of 4, every single year since 2009 has been crypto. And then there's 1 year, which is a bad down year, and then it continues. In the down year, it's the worst performing asset. But over time, it's compounded higher than any single asset class we've ever seen in history. So if that's the case, every other trade-off is suboptimal. Now, I can take that risk because I have income and I've got, assets. So I can take big risks because I think this is the biggest macro setup of all time. So I'll take that risk. But for other people, you can express some of these views without taking as much risk. If you believe in the debasement of currency, yes, you can use gold, but gold hasn't offset it very well. Yes, you could be cyclical and trade commodities. There'll be, as soon as we start going to macro summer, commodity prices will rise. You can make money from that. And a lot of people you and I know all came to the same conclusion. We've seen it, Dan Tapiero, Dan Moorhead, Mark Yusko, all of these people, one after the other. A lot of them all were GMI people. We all found about it. We all went through this journey together back in 2012. People have just realized it is the mega trend. Now, again, it's not for everybody. You have to deal with some huge ups and downs. But, there are ways of playing it in the equity market, stuff like Coinbase, stuff like that. Or otherwise, I just think you're going to be underperforming the debasement of currency. So the standard, I'm going to stick my money in the S&P 500 ETF, you're just not going to get anywhere. That house price is still going to go up, and you're just not going to make it any excess returns. And it's a really serious situation. People don't want to understand it. They don't like this narrative. They don't like to be told that, most assets aren't worth investing anymore. But it's true. It's the down cycle where you add that makes you all the money. So I spent all of last year buying Solana, Ethereum into the massive sell-offs, because then you compound much faster. So you should be embracing the volatility if you've got a long-term view. If your view is 1 year, 1 year, 3 years, 3 months, it's much harder to deal with. It's so volatile. But when you just zoom out, use the logarithmic trend, and has the adoption of this technology changed or not? No, keep going. And that was it. So it's a psychology change of understanding long time horizons. And I've found that long time horizons are a superpower. What is going to stop this technological revolution accelerating? If you can find me a reason that this stops, as opposed to the business cycle, rates go up, blah, 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 it comes down. I can't find reasons. Just when you throw AI, robotics, space, EV, it's like a massive structural change.